What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to break down the personal consumption expenditure numbers. So the PCE numbers just came out a few minutes ago. So we're going to talk about those and then also talk about the current state of fiscal policy with respect to interest rates, interest payments, tax receipts, which are basically the income for the government, and also talk a little bit about the debt to GDP numbers and of course the overall interest rate on US denominated debt as well in terms of treasuries. So hope you guys enjoy this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. There is a 16% annual discount available till the end of this month. So tonight literally is the last day if you want to take advantage of that. After midnight, it does expire, and the fundamental and technical analysis courses as well as the options course is going to be 50 to 60% off. And that's also going to be with the link down below, coupon code LABOR4, that's available till Monday. So both links down in the description below. So when it comes to the personal income and outlays, personal consumption expenditure, which is the Fed's preferred measure of inflation, actually ticked higher. So you'll notice that PCE on a year-over-year basis, prior number was 3%. We ticked higher to 3.3%. So definitely moving higher a little bit here. Core PCE came in at 0.2%, and year-over-year also ticking higher from 4.1 to 4.2%. Now, this is certainly not the print, in my opinion, at least what we wanted to see. We want to see the trend obviously go the opposite direction, which is lower. And we want to see, of course, PCE price index year over year to come down to closer to 2%. And more importantly, core inflation, which is core PCE, come down to 2%. But right now it's trading at well over 2 times that number, ticking higher for both accounts. Now, this obviously is going to spur some uncertainty around interest rates once again, because the Federal Reserve has already mentioned that they are not going to shy away from raising interest rates if they need to continue to bring down inflation, or at least in this fight of bringing inflation down. So that is an important aspect to this overall equation. Now, going over to the government debt. So the gigantic US government debt is now approaching $33 trillion, right? So three big ones amid the tsunami of issuance of treasury securities to fund the mind-blowing government deficits and roll over maturing securities as well. So what really happens in this type of scenario is that all the government issued debt that was already issued, let's say 5 years ago or a couple of years ago, was obviously issued at a lower rate because interest rates were substantially lower. Now, what is the government doing, right? The government is basically issuing more debt, right, to basically finance the deficits and also replace the old debt with the new debt. But the problem is that the old debt was financed at a lower rate. The new debt is being financed at a much higher rate because interest rates are higher now. And again, short-term treasuries, long-term treasuries, they're sitting at 3%, 4%, 5%. So if you look at the maturities of these types of issuances, they are now going to be at a much higher rate, right? In other words, the cost of borrowing for the US government is now substantially higher compared to 2 years ago or 5 years ago. So if they are going to be replacing all that old debt with new debt, that's all fine and dandy, but they're going to be doing it at a much higher interest rate. So that's exactly what's been mentioned here. But the higher interest rates the government pays now apply only to the new treasury securities to fund the new deficits and to replace the maturing securities with the lower interest rates. So the securities issued years ago will cost the government whatever coupon interest rate they came up with until they mature. But the average interest rate that the government is paying on all of its interest-bearing debt has been ticking higher gradually from a historic low point of 1.57% in February to almost 3% in July. And that is, again, very normal. It's almost increased 100%. That's because interest rates are higher. And this is only going to go up because the deficits continue, issuances continue, and rates are going to basically stay here higher for longer. And again, we just got the inflation print, which ticked higher, which again increases the probability for the Federal Reserve to increase interest rates once again. Maybe another 25 basis points, maybe another 50 basis points in the next couple of months. Who knows? But the bottom line is interest rates are going to stay higher for longer until inflation is down to 2%. Now, to what extent interest payments eat up tax revenues? This is also a very, very important metric for us to understand is what percentage of all the tax revenues that are coming in, so all what the incoming receipts are, what percentage of that is basically going into interest payments and not paying down the principal on that debt. So that is going to be over 36%. So over a third of tax receipts are going towards interest payments. Interest payments only. Nothing to do with the principal, nothing to do with investments in infrastructure or defense or Medicare or education, nothing like that. Over a third of the tax revenues are just going for interest payment on the existing debt. And that is up from 33% in the first quarter and up from 21% from a year ago. So again, as overall debt increases, as interest rate increases, the interest on that debt obviously goes up and eats into the tax revenues that the government is collecting. This right here is the historical averages. You can see this huge spike in the overall interest payments as a percentage of tax receipts. But again, this is a little bit of I want to give you some context because tax receipts from last year were really low because capital gains weren't that high. Of course, because 2022 was a bear market. It was a brutal year for the market. So tax revenues fell to $670 billion for 2022 because of the capital gains inflated spike because of the, again, markets being down, not a lot of people basically generating capital gains. And as a result, it was a lousy year for investors with all kinds of asset classes getting bashed down and some brutally. And as a consequence, capital gains taxes for the year 2022 paid by April 15, 2023 plunged for that year. But personal income taxes have continued to soar. So whatever was lost by capital gains was made up somewhat by personal income tax because wages have been increasing. And we've seen some of the biggest pay increases in over 40 years, which the government extracted its pound of flesh. Income tax revenue rise with growing employment and wage inflation as well. So this basically shows us the huge significant decline in the tax receipts and the amount of increase in interest expenses because of the rise of debt and the rise of interest rates as well. And that difference obviously is slowing down a little bit, right? So that obviously is not the best situation to be because you can see the rise and fall of capital gains taxes. So we saw a huge spike in 2020, 2021 because lots of people made money. And 2022 obviously was a brutal year for the markets and for investors as well. So this is where we are, obviously at over interest payments as a percentage of GDP is still pretty low, 3.6%. But again, a huge spike that cannot be ignored because we are, once again, for the longest time sitting at below these levels, below 3 to 4%, and now we're getting up to almost 4% once again, and seeing a huge spike in these numbers. So interest payments as a percentage of GDP and tax revenues is definitely spiking to some extreme levels because of the, at least in my opinion, the mismanagement of debt and fiscal policy in the U.S. So again, this is just one of those things that is going to be a topic of conversation and discussion over the course of our next several years of investing journey, because this is not like one catalyst that's going to act as a negative catalyst for the markets today, but this is something that we definitely need to be paying attention to because the debt levels are obviously not going down. They're obviously moving in the opposite direction, not to mention the interest payments on that debt also going higher and higher, eating into more of the tax revenues, eating into more of the potential GDP as well. So just wanted to point that out. These are some scary statistics, and that's exactly one of the reasons why we have to, again, start looking into maybe other opportunities as well. The US is fantastic. It's one of the most popular, most traded, most volume markets in the world, biggest markets in the world, but there's still opportunity in European markets, in Asian markets. There is a lot of opportunity to diversify and look for opportunities in those areas as well. And that's exactly where MoneyVest Europe and MoneyVest Asia and some of the other parts of our segments, other parts of our channels come in. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. Don't forget, there is a 16% annual discount that does expire tonight. So after midnight, it will go away. You can take advantage of that while it's still here. And fundamental and tech analysis course are also going to be 50 to 60% off. Coupon code LABOR4. As always, happy investing. I'll see you all in the next video.